Hi, my name is Richard Glover with American Fidelity Mortgage Services. I'm the director of the Reverse Mortgage Lending Division. And we're really working hard to become the leading provider of reverse mortgages in the Chicagoland area. We're working on getting our name out there from the standpoint of being a lender in the reverse mortgage space. And here's our contact information behind me. We had it up on the screen. We maintain an 800 number, 800-365-3539. And we do that because if seniors are paying for long distance, we don't want to have them pay for a phone call to contact us. Our 847-464-8080 number will get somebody directly on the phone. And then please visit our website, www.americanfidelityreverse.com. It has a link to our Google Plus page, as well as a lot of really good information about reverse mortgages. As I mentioned, I'm the director of the Reverse Mortgage Lending Division. We have a team of people out on the street that specialize in the reverse mortgage, have obtained specific training, and get a lot of support on the back end from our corporate office here in Lisle, Illinois. Along with that, we do a lot of things to maintain a strong reputation in the community with different organizations. A few of those are the National Reverse Mortgage Lenders Association. It's a nationwide governing body of the reverse mortgage in general. It's a lobbying group. We work with HUD. We work on a lot of things with the image of the product, and I think a lot of what we're going to talk about today has to do with some of that image aspect. Another place that we have an affiliation is the BBB. We're an A+ rated company with the Better Business Bureau, and we are an affiliated company. And then the third thing that we have an important aspect to is that we are a HUD-approved, direct endorsed FHA lender. That makes us very unique with respect to the fact that we underwrite our own files, we fund our own loans. We're always have been historically a large FHA lender in the Chicagoland area. And in addition to that, we're a direct lender of the reverse mortgages. Here's some of our legal information, just some of your things that we need to put out there for advertising purposes. This information is copywritten. And then we do business in Indiana, we do business in Wisconsin, and that's the information that they require us to provide whenever we do what this might be construed as advertising. And then the state of Illinois requires that anything we do has the Department of Financial Regulations information in there. What we're going to talk about today is financial planning in reverse mortgages. And the big thing about that is that a lot of the things I've seen in the media lately have to do with reverse mortgages and equity stripping. And a reverse mortgage is actually a product, when used properly, the best financial program available to seniors today. It was designed during the Reagan years to help people be able to afford to stay in their homes. When you think about it, the largest asset most people have is their home equity. And the biggest misconception is that a reverse mortgage is going to harm somebody because it's making them take the equity out of their home. Contrary to that, the reality is a reverse mortgage, as intended, is allowing you to access your equity in your home as you need it. And so if we do look at the fourth component to retirement, it's often your biggest asset. It puts your money to work for you. And the conversation I've been having with a lot of people lately is, if you do this, if you do a reverse mortgage, home equity line of credit, so a home equity conversion mortgage line of credit would really be the proper term. If you do this, you won't run out of money. If you don't do this, you're pretty likely to run out of money. We get into that a lot with people who have a mortgage and a mortgage payment that they're making, and it's almost as if you're borrowing from Peter to pay Paul. So you're taking money out of your retirement funds to make a mortgage payment, which doesn't really make a lot of sense. You're reducing your asset to pay down a loan, and it creates a lot of cash flow situations and problems. On top of that, there's an income issue because the money that you're drawing from your accounts can be income that's used to pay your mortgage. So you can put yourself over, in our area, in the Chicagoland area, the threshold is $55,000 a year. You get a lot of property tax benefits and senior exemption benefits from your county assessor and on your county taxes if you stay under $55,000 a year. If you're drawing money to make a mortgage payment, you're increasing your income, which can cause problems down the road for you. So that's a little bit about the financial planning in the reverse. The person we're going to talk about today is a 65-year-old person with a $250,000 house. That's about the median price of a home in the suburban areas of Chicago. For this example, we're using a 4.89 interest rate, and your credit line grows at a rate equal to your interest rate. And where we pull that number from is we say, look, I think it's fair over the next 10 years to assume that your interest rate is going to be about 5%. Rates are going to go up, rates are going to go down, and during that time they're going to meander around, and on average, if we say 5%, I think we're pretty conservative. When you start in the program, you're going to be around 4.25 with a interest rate, and I would say based on the current economic climate, you're going to stay there at least for a year. And there's some talk that maybe into 2016 the Fed raises rates. Again, that doesn't mean we're going to go from 4.25 to 6 overnight. We're going to go from 4.25 maybe to 4.5, maybe to 4.75, maybe to 5. Eventually we go to 6, come back down. So 5 on average. Person has no mortgage. Now, a lot of people think, well, I got to have a mortgage to get a reverse mortgage, or can I get a reverse mortgage if I don't have a mortgage? It's not a component of it. And we're going to look at a lot of different options to this as we go through. But today I just want to educate people on the basics of the home equity line of credit, how it works, and as I've talked about before, the growth rate of the home equity line of credit. If everybody could get and understand this and see what a great planning tool this is, I believe we'd have a line outside our door of people saying, you know what, I need to get a reverse mortgage because I don't need the money today, but I'm going to need it down the road. And if I do it today, I'm going to have access to more money when I need it the most. And that's where people really miss out, because people go, oh, I'll wait 5 years and do my reverse then. You have the bird in the hand aspect of we know what you're getting today, and it's here, it's now, and if you're 65, like the person in our example is going to be, then where will you be at 75? And how can this help you at 70 or 75? And we're going to look at those components. A couple of key terms that we're going to get into, and this is where it gets a little bit confusing and hopefully we can simplify it, is utilization. Utilization is basically the amount of money that you're using. And it came into play November 2013 that people were capped at 60% utilization if they didn't have a mortgage. And in reward or the benefit of 60% utilization or less is that you pay lower mortgage insurance. A lot of things that people are talking about with reverse mortgages is that they can be expensive. And the reality is we've done some pretty low cost reverse mortgages in 2014 and will continue to do them in 2015. One of the big changes, the big components of that is if you have less than 60% utilization, then you're only paying 0.5% mortgage insurance. If you do have a situation where you need more than 60% utilization, the only way that can happen is if you have mandatory obligations. And what mandatory obligations are your mortgage that you're paying off, taxes, maybe you have some property taxes that are due at the time of closing, insurance, maybe there's a small insurance premium. We run into a lot of people who pay monthly, so we got to pay them forward 60 days to make sure they're covered. And then closing costs or fees. And we're going to just get into the basic stuff when we look at this first loan example, but that's some of your key terms there.